All right, let's talk about financial reports. Today, we're going to peel back the layers and look at something most people never even think about, the secret choices that actually shape the numbers we see. So, let me kick things off with a question for you. When you grab the financial reports for two different companies, even two companies in the exact same business, can you really assume you're comparing apples to apples? Are their numbers calculated in precisely the same way? The short and maybe surprising answer is absolutely not. And that one little word, no, opens up this whole fascinating world of judgment, strategy, and choice that's happening behind the scenes. This gets to the heart of a huge misconception. I think a lot of us imagine there's just one giant universal rule book for accounting that everybody follows to the letter. But that's not really how it works. And when you think about it, it totally makes sense, right? A brand new tech startup is just a completely different beast than a century-old car manufacturer. The business world is just way too complex for some kind of one-size-fits-all set of rules. Okay, so if it's not one single rule book, then what's really going on? Well, this is where something called accounting policies comes into play. You can think of them as the specific rules within the bigger, broader rules of accounting. And here's the official definition for you. Accounting policies are the specific principles and the methods for applying them that a company actively chooses when it puts together its financial statements. It's not about if you report something, it's all about how you report it. And look, this isn't some abstract theoretical thing. Companies are making these choices in really important areas that have a direct impact on the bottom line. Like, how do they put a dollar value on all the stuff sitting in their warehouse, their inventory? Or how do they value their investments? But wait, this doesn't mean it's the Wild West. These choices aren't just made on a whim. There's actually a framework, a set of guiding principles that helps management pick the right policies for their business. It really comes down to three big ideas. The first is prudence, which basically just means being cautious and not getting ahead of yourself by overstating how well you're doing. The second is substance over form, meaning the accounting should show what's really happening economically, not just what the legal paperwork says. And finally, materiality, which is all about focusing on the information that's actually big enough to matter, to influence someone's decision. All right, this is where the rubber meets the road. Let's look at how a simple policy choice can have a massive impact on a company's profit. So let's stick with that inventory example. Imagine a company that sells, hats. And over the course of the year, the price they pay for those hats keeps going up. So how do they account for the cost of the hats they've sold? Well, they've got options. They could use the FIFO method, that's first in, first out, which assumes they sold the oldest, cheapest hats first. In a time of rising prices, this makes their profit look bigger. Or they could use the weighted average method, which kind of smooths everything out by averaging the cost of all the hats together. Now think about that. Same company, same number of hats sold, but potentially two very different profit numbers. That's the power of just one accounting policy. Okay, so this probably has you thinking, what's to stop a company from just gaming the system? If they can make their profits look bigger just by changing a policy, why wouldn't they just switch back and forth all the time? So let's just ask it straight up. Can a business really change its accounting policies anytime it wants just to make the numbers look a little better that quarter? And the answer, thankfully, is a hard no. The rules are actually super strict on this. A company can only change a policy if one of two things is true. Either a new law or standard says they have to, or, and this is key, if the change actually gives a more accurate, a more appropriate picture of the company's finances. You can't just do it for fun or to fudge the numbers. Okay, so what's the big takeaway here? Why should you care about all this? Well, because understanding this one concept completely changes how you read a financial report. It makes you a much, much smarter reader. Because here's the bottom line, and this is a quote straight from the source material. Choosing the wrong policy can seriously understate or overstate a company's real performance. It can make a healthy company look sick or a struggling one look like a rock star. The stakes are huge. So just knowing that these choices are being made, it's like getting a backstage pass. You're not just looking at the final numbers on the page anymore. You're able to look behind the curtain and start to understand the decisions and the judgments that went into creating those numbers. So I'll leave you with this thought. The next time you open up an annual report, don't just see the numbers. Try to see the story and the choices behind them. What hidden choices will you be on the lookout for? Thanks for tuning in.